Good morning from our global headquarters in New York. I'm Danny Berger. Manus Cranny is off today. Welcome to your Bloomberg Brief. Let's set your agenda. No exceptions, no exemptions. The steel and aluminum tariffs officially kick in. President Trump walks back his double levy for Canada.
The president is unwavering in his commitment to restore American manufacturing and global dominance, and I think he doubled down on that with his new statement and the tariffs that will be implemented on steel and aluminum.
Europe fights back. The EU targets $28 billion worth of American goods in countermeasures.
The US administration has opted to pursue a harmful course of unjustified tariffs, leaving us with no choice but to respond, and that's exactly what we are doing.
And on the brink of a correction, dip buyers go missing ahead of the latest inflation print in America. And you are about 3.5 hours away from that CPI print. The expectation is a 0.3% increase month over month for both headline and core. That comes off the back of being down 9.3% from the peak in equities. Are the dip buyers finally showing up this morning? They certainly didn't yesterday after we ended lower. S&P 500 futures up 0.6%. More for the NASDAQ and the Russell 2000, which have been looking weaker as of late. Treasuries did indeed sell off yesterday. That was off the back of a strong jolt, showing that there is demand for labor, that the quits rate moved up to a 6-month high. That, though, some of that selling easing off for a little change this morning. We are at 3.9% on your 2-year yield. Your 10-year yield stands at 4.27. And we also have some individual stocks we're keeping our eye on this morning. This one's an interesting one. Earlier in the month, we had talked about Walmart trying to push its price increases to its Chinese suppliers. Well, now Walmart is facing heat from China over those reports that it asked suppliers to bear the cost of rising prices from tariffs. The authorities warned that Walmart's demands could fracture the global supply chain. Those shares down 0.7%. Shares of Puma, those looking really sour in the European trade, down 22.33%. The company reported softer than expected results and forecast lower growth. We heard something from them that we also heard from the plane airlines yesterday, that demand is struggling in the U.S. They also pointed to China as a weak spot for demand, too. Finally, wrapping things up with Stitch Fix, that is on the upside in the pre-market trade, up 20.5%. The personal styling platform boosted its full-year revenue forecast. The company says its turnaround efforts are working, even as sales continue to fall. In just a few moments, we are going to be catching up with Seema Shah of Principal Asset Management. Later in the hour, we'll be speaking with Priya Misra of JPMorgan. And on the tariffs of steel and aluminum tariffs coming in, we're going to be catching up with Jeremy Flack of Flack Global Metals. But first, just want to bring you some live pictures. ECB President Christine Lagarde is currently speaking at the ECB, giving her annual address and its Watchers Conference in Frankfurt. If you want to tune in live to that, Live Go is where you want to watch it. Just some of the headlines that have come out of that. She is talking about a new era of shocks. She says a new era of shocks makes the ECB's inflation job harder, that maintaining stability will be a formidable task, and it is a moment where central banks need to show agility. Again, Madame Lagarde speaking there in front of the ECB and its Watchers Conference in Frankfurt. You can tune into that on Live Go, speaking about the shocks and uncertainty in this market. Speaking of shocks and uncertainties, back to the main story of the day. It is tariffs. Principal Seema Shah weighs in on the impact and writes, near-term tariff uncertainty may dampen business confidence in CapEx, pushing risk premiums higher and weighing on asset prices. However, the U.S. economy remains resilient. This backdrop suggests selective opportunities and positive market returns. I'm pleased to say that Seema joins me now. She's Chief Global Strategist at Principal Asset Management. Seema, great to see you this morning. That last bit of your thoughts there, does that mean with the S&P nearing a correction down more than 9% from the highs, that you see some buying opportunities?
So, hi, Danny. I think there are buying opportunities. I think the S&P 500 itself, there is still so much uncertainty. There's still so many fears about how actual policy is going to impact the economy as it starts to come in, that it may, we may still see investors wanting to kind of wait around before they start to dip their feet directly into the index. But there are opportunities underneath that index level. Some of the sectors which are somewhat untouched by the tariffs can still, continue to prosper even in this fairly uncertain environment. Some of the ones that we do like financials, utilities, for example, even healthcare. So there are opportunities, but at this point in time, it is really important for investors to actually directly seek them rather than just going straight to the index level.
Can I just linger on that financials points? Because banks have gotten really caught up with the latest turmoil because the concern is one of growth and that hitting financials. Banks, smaller banks in particular. Why do you like the sector?
Yeah, you're right. So I think, it had a wonderful rally in the first part of the year, and now it started to shift. So we're still fairly confident about the US economic outlook. Certainly the odds of recession have increased. That is true. But when we're looking at the data, what we're anticipating is a slowdown. We were already anticipating a slowdown. We have reduced the forecast slightly. But we don't see recession hitting. We are making a number of assumptions for the second half of the year, though, and those are really key. So we assume that a number of the tariffs, of course, not all of them, but some of the tariffs are lifted in the second half of the year. We're also assuming some Fed cuts. The inflation print later today is going to be really important in paving that way, potentially for Fed easing later in the year. And the third thing is that we're still looking for deregulation. So some of this growth-friendly policies that we didn't see at the beginning of the year still expected to come in the second half of the year, and then that hopefully boosting the economy and enabling the US to skirt recession. So if that is correct, it still means that financials have got some headway to run. And maybe we see some of the losses in the last couple of days being reversed.
In terms of what we could get from policy that could help reverse some of the losses, Seema, you pointed to one of them, some of the more market-friendly measures. This I thought was interesting, though, from the Wall Street Journal. They have on their front page the story that Trump's economic message is spooking some of his advisors. This is what the journalist there wrote, that many in the business community have abandoned efforts to get the president to reverse course on trade, instead pleading with the White House for clarity on his approach, the People said. Seema, is there some degree we're just getting clarity on tariffs, not even necessarily of backing off on tariffs, but that in itself could support risk assets?
Yes, absolutely. We're already seeing that policy uncertainty is weighing on business capex. I mean, businesses, if they really don't know what the policies are, what do? They just kind of stand still. They cancel the various investment plans and maybe pause hiring. So this in itself, that level of uncertainty is very damaging. We just heard from Lagarde referring to it just now in her speech. So we are clearly seeing an impact. It is important, of course, to remember that you've rarely had recession. I think you've never had recession in the US just from policy uncertainty. But certainly having some kind of clarity about what the Trump administration is planning with regards to tariffs and potentially the broad policy mix, how are they directing the US economy? Where are their pressure points? Those kind of things would certainly help businesses plan and provide a bit of a boost.
Well, you make a good point that Lagarde is speaking about it. This isn't just an America's problem. It's a Europe problem, too, now that they also face tariffs and have put retaliatory tariffs in. Seema, we saw a sell-off yesterday in U.S. assets that also spilled into Europe. Previously, to start this year, it had been more of a rotation. U.S. sells off, and we buy into Europe, and we buy into the rest of the world. Is that rotationary trade coming towards an end? Is the uncertainty now manifesting in risk off in general across the globe?
So this is a really interesting question. We do think that the outlook for European assets has shifted really fundamentally to the positive side. But we have to remember that it's rare for global assets to avoid any kind of US weakness. So that uncertainty weighing into European assets is, it's likely to continue. We just have to think about the various approaches that countries are trying to figure out. What is the best way of approaching and retaliating? Do they push back or do they kind of sit still like the UK? That is still to be seen, and that weighs on that global outlook of uncertainty. I think specifically with Europe, though, a lot of it is still down to what's going to happen with Germany next week. If it does manage to pass those measures, that does lift the economic growth rate for Germany and parts of Europe. And so we would expect that rally to get back into play. But of course, there's going to be pockets of weakness through this year, not just in the US, but certainly in global markets too.
Well, certainly there are hopes that the Greens will reach some sort of negotiation. They can lift that debt brake. Seema, really great to catch up with you. Seema Shah, a principal asset management. Thanks for your time this morning. Let's get you some other stories now that are trending on the terminal. Rheinmetall predicting revenue will grow by 25 to 30% this year. The German arms manufacturer has been benefiting from surging European defense spending. Speaking of what's happening in Germany, the CEO says that demand is bringing growth forward that it has never experienced before. Shares have surged more than 1,000% since Russia invaded Ukraine and more than doubled in the past year. Porsche has lowered another profitability goal set at the time of its blockbuster IPO listing. That's off the back of lackluster earnings with weak sales in China. Porsche will start an extensive rescaling this year, investing in models, software, and batteries that will hit this year's results. Now, elsewhere in Washington, House Republicans passed legislation to keep the U.S. government open past a Saturday shutdown deadline. That bill will likely need the support of at least 8 Democrats in the Senate to become law. If the measure fails in the Senate, though, Republican congressional leaders could try to pass a shorter-term stopgap later in the week. Coming up, we're going to get more details on the latest tariffs, the latest retaliations, a fast-moving story. That's coming up next on your Bloomberg Brief. President Trump's metals tariffs are in effect. That's a 25% levy on steel and aluminum imports. For the EU, it marks a massive escalation on the trade war. China, meanwhile, is vowing all necessary measures in response. And Japan's spokesperson calls the levies, quote, regrettable. Joining us now is Bloomberg's Brendan Murray, who leads on international trade coverage. Brendan, first, let's just start off with what we actually have in effect, because there was a lot of back and forth yesterday. What exactly do we have in terms of metal tariffs?
So we have 25% tariffs on all imports of U.S. raw steel and aluminum, plus consumer products made of those metals. So things about $150 billion worth of imports of consumer goods like caskets, like baseball bats. There are a whole range of things that are made from steel and aluminum. As I said, $150 billion worth of imports. So those will translate into a fairly immediate increase in some of the prices of those goods. What we saw in the aftermath of the deadline of midnight last night in Washington was countries threatening to retaliate, but not a whole lot of actual retaliation against something that was pretty well telegraphed. So that tells you the big steel exporters, countries like Japan, South Korea, China, and the countries of the European Union are looking to sit down and negotiate their way out of some of this. The European Union struck perhaps the harshest tone and said, they actually laid out their dates for retaliation and said, put dollar figures on the amount of products, of American products that they're gonna hit. But we've seen a range of responses from no commenting to we're going to hit you back on April 1 or thereabouts from the European Union.
Yeah. Again, no exemptions for this, even with some places that there hoped there would be, like Australia was hoping for an exemption, for example. Brendan, thank you so much. Bloomberg's Brendan Murray. And as he mentioned, Europe is fighting back. So over to Brussels, the European Union launching countermeasures. It plans to impose its own levies on around $28 billion worth of goods. European Commission President Ursula von der Leyen laid out the bloc's plans earlier. Take a listen.
Our countermeasures will be introduced in 2 steps, starting with April 1st and fully in place as of April 13th. In the meantime, we will always remain open to negotiations. We firmly believe that in a world fraught with geo-economic and political uncertainties, it is not in our common interest to burden our economies with such tariffs.
Joining us now from Berlin is Bloomberg's Oliver Crook. And Brendan also mentioned it. This is kind of the strongest response that we've seen from any nations, Oliver. What led Europe to this point?
Yeah, I mean, I think that they believe that they are sort of in a position to do a little bit of negotiating and a little bit of fighting back to the United States. We should say that the trading relationship between the EU and the United States last year was about $1 trillion. So this is a massive trading relationship. But having said that, $1 trillion, they're talking about retaliating on about $28 billion worth of goods. So it's, again, this is kind of a drop in the bucket when it comes to the real trade war that could come between the EU and the United States, which really would be in April. And that has to do with the focus on VAT, reciprocal tariffs on cars, the pharmaceutical pharmaceutical industry, that is where the real pain is going to come. We don't have the list yet from the EU on how they're going to retaliate. We know from last time around some of the things that were on that list were bourbon. Apparently there's $1 billion worth of bourbon that's imported into the EU, iron, cosmetics, electronics, those sorts of things. But I think, Danny, actually the way in which that these particular tariffs hit Europe the most have actually nothing to do with trade between Europe and the United States. It has to do with the trade barriers that are erected around the United States, meaning that a lot of the steel that is going to be coming into the U.S. from other places like China and other places where it's produced much more inexpensively, all of that shipment gets redirected to other markets that can absorb it, and that is going to be the EU, a very sort of rich continent that can buy a lot of this stuff. And that means that for the steel industry here in Europe, which is already struggling, they cut about 18,000 jobs last year. They had to pull about 9,000 tons off of their own sort of domestic production. And this is one of the biggest issues here for the European Commission, sort of competitive industrial environment here in Europe. And this means that a lot of that is going to be redirected to Europe. So could you have basically a second-hand trade war where now Europe needs to erect trade barriers with other partners in order to prevent that cheaper steel and aluminum from coming into its territory?
Oliver, it is such an excellent point. And it is also a pushback to the bulls who saw the case to buy Europe because of the amount of spending that would be happening and the lift to the economy because of that. What does the balance look like at this moment? Will Europe at least be headed down that road? Will Germany be able to lift its debt brake? Does it at least have a more balanced economy if it is going to be dealing with these tariff threats?
I mean, I think that is the reality that basically a chancellor candidate in the form of Friedrich Merz from the Conservatives, who basically ran on not reforming the debt brake about 3 days after the election, decided, hey, you know what we're going to do? We're going to reform the debt brake. I think, though, that the problem is, Danny, that the market got a little bit ahead of itself in pricing in basically, potentially €1 trillion of debt finance spending by the German government, which is not yet assured. Again, this still needs to be negotiated. The market got a little ahead of itself.
Oliver, always great to hear from you. Oliver Crook there with the latest on the EU. Coming up, we're going to take a look at the front pages this morning on your Bloomberg Brief. Let's take a look at the front pages on this Wednesday morning. First up, Reuters reporting that TSMC has pitched NVIDIA, AMD, and Broadcom on taking stakes in a joint venture that would operate Intel's factories. Under that proposal, TSMC would run the operations of Intel's foundry division, but it would not own more than 50%. Next up, the Wall Street Journal has this on their front page. The Education Department is cutting its workforce by roughly half. The official said it was eliminating full teams whose operations are deemed redundant or unnecessary. Now on the Bloomberg, we have this. Ukraine has accepted a proposal for a 30-day truce with Russia as part of a deal to lift its freeze on military aid and intelligence. President Trump spoke to reporters about the deal outside the White House.
Ukraine has agreed to it, and hopefully Russia will agree to it. We're going to meet with them later on today and tomorrow, and hopefully we'll be able to wipe out a deal. But I think the ceasefire is very important. If we can get Russia to do it, that'll be great.
Joining us now for more on this is Bloomberg's Greg Sullivan. Greg, great to see you this morning. What has actually been agreed between the U.S. and Ukraine?
Well, we know a few things. One is that Ukraine has agreed to the broad terms of a 30-day ceasefire, assuming that Russia also eventually agrees to it. We also know that that came after intense White House pressure following the disastrous Oval Office meeting between President Zelensky and President Trump. The White House has been piling pressure onto the Ukrainian side to come to the table and make these agreements. But as part of those agreements, the U.S. has also agreed to lift its freeze on sharing military aid and intelligence with Ukraine. So that is quite a significant step there. What is not included in the deal, however, are security guarantees that Ukraine has insisted are necessary for any sustainable peace. So that will be something to look for moving forward. The other thing, of course, that's not agreed to here is the Russian participation in this deal.
Exactly, Greg. So how likely is it that we will have Russian participation in this deal? Will the Kremlin agree to the terms laid out?
This is the key question here. One thing that we do know is that the terms that were agreed to fall short of what the Kremlin has said they need for any cessation of hostilities. Now, we know that President Trump has said that the U.S. will engage with Russian counterparts as soon as today. His special envoy, Steve Witkoff, is expected in Moscow. He's the Middle East envoy, but he's been very engaged in the Russian process. So we should know more about Russia's response to that coming forward. But in the past, Russia has ruled out a short-term ceasefire unless there are serious discussions about parameters for a more long-term peace. And so far, that's just not evident in this agreement.
Well, Greg, quickly here, and to your point, how does this bring about long-term peace? Because Ukraine's not getting the security backing that it wanted.
Well, on one hand, this does seem to be President Trump's strategy, is to force both sides to the negotiating table for a short-term truce under which longer-term negotiations can begin. Zelensky said that he would like to see a prisoner exchange happen to build up trust. However, the Russian side has warned that they believe Ukraine will just rearm under any short-term truce. And as you mentioned, those security guarantees, that will be a key sticking point in any long-term negotiation, as well as the size of the Ukrainian military going forth. And right now, it's really hard to see an agreement on what specific security guarantees will be palatable to all sides and still a deterrent to Russia.
Greg, thank you so much for the update. That is Bloomberg's Greg Sullivan. Coming up on the show, it's CPI day. We're going to push ahead with JPMorgan's Priya Misra. She'll be joining us next. You're watching Bloomberg Brief. From our global headquarters in New York City, you're welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. No exceptions, no exemptions. The steel and aluminum tariffs officially kick in. President Trump walks back his double levy for Canada.
Is unwavering in his commitment to restore American manufacturing and global dominance. And I think he doubled down on that with his new statement and the tariffs that will be implemented on steel and aluminum.
Europe fights back. The EU targets $28 billion worth of American goods and countermeasures.
The US administration has opted to pursue a harmful course of unjustified tariffs, leaving us with no choice but to respond, and that's exactly what we are doing.
On the brink of a correction, dip buyers go missing ahead of the latest inflation print in America. We are down 9.3% from the highs, so just inching towards something that looks like a correction. We have downgrades from Goldman, from Citi, from HSBC on their equity market calls, but we attempt to bounce back this morning, led by tech, which let us lower yesterday, up 0.7%. Treasuries, they did sell off yesterday. That seemed to be in reaction to the JOLTS figures, showing that there is indeed demand for labor and the quits rates moving higher. Today, we take a breather from that. We are little change across the curve this morning, 3.94 on your 2-year yield. Your 10-year yield stands at 4.27. So in 3 hours' time, we will be getting CPI coming in, the latest inflation reading in what has been a very volatile market reacting to data and headlines. Pleased to say that Bloomberg's Mike McKee joins us now. Mike, always great to see you on a data morning, getting up early for us. So what are we expecting today from CPI?
I think I'd call it the calm before the storm, because this is going to reflect prices and company decisions that were made when Donald Trump was just coming into office and all we had was rhetoric. We may see a few things go up in price, but maybe PPI tomorrow is going to give us more of a clue as to the tariff implications. Instead, what we're likely to get is a slight improvement overall in consumer prices, in part because of the time of year and in part because of the things that are going up and down. We get a little bit of a break on both headline and core on a month-over-month basis, which pushes the year-over-year numbers down. So that would be relatively good news. But is this the end of what we see as good news? Because, as I mentioned, the tariffs are starting to come on now. And what we have seen for the past year or so is a drop in services prices, or drop in goods prices, and services prices have been rising. Now, services prices might be starting to come down. We're expecting a little bit less in terms of airfares, things like that, a little bit more in terms of goods that tariffs will be on. So we'll watch that for some kind of clues as to what we might get from this month. And I'll come back when we get the March CPI, and we'll see if it's any better.
I was going to say, you have no choice but to come back. So thank you for that, Mike. But is there not some sense that, at least we got from the Beige Book, that there are firms who are preemptively hiking their prices ahead of tariffs?
Well, we have seen that. The question is how many and how much. We know that car prices went up some, but overall, used car prices are expected to fall this month, in part because of seasonal reasons. But people buying things ahead of tariffs is what has pushed up prices, because it's a law of supply and demand. But also, when you put on tariffs, the domestic producers tend to raise prices because they can. That's the whole point of tariffs, is to get them more money. So we'll have to see, and this will show up more in the PPI than CPI, we'll have to see how much of that has flowed through to the consumer. Probably not much this month.
Mike, we look forward to breaking down the data in a little under 3 hours' time. That is Bloomberg's Michael McKee. Joining us now around the table is Priya Misra, Portfolio Manager at JPMorgan Investment Management. Priya, good morning to you. Thanks so much for joining. Do you have an understanding of how the market would likely react to a CPI print that maybe comes in a little bit hotter? How crucial or not crucial is this data point?
So remember when CPI was the most important number? We waited all month for it.
I don't think it was that long ago.
I know, and I almost think it doesn't matter. Well, partly, to Mike's point, it's a lagging number, so it's before the tariffs have come in. Partly because I think the market has moved from inflation fears, or, you know, will that allow the Fed to cut rates? I mean, the Fed has cut 100 basis points, to now growth fears. And so I think if you do get a little bit hotter, I think what it's going to tell us is we're going into this policy uncertainty period with higher inflation. I still think, you know, can inflation be sustained? We're going to be looking at services. Mike talked about that. I'm looking at wages, because it's possible that tariffs are going to create this one-time price shock. Service inflation, it's sort of less impacted by tariffs. But if that's already high, you're looking at a higher inflation number, which means that the Fed really can't offset a lot. And so then we're going to look at, okay, how much policy easing is required if we're going to get a combination of, you know, whether it's the DOGE-related, you know, job losses, what is the spillover into the private sector? So we'll be looking at that. Plus, what's the impact of uncertainty? I just think about a consumer, you know, that's thinking about a big purchase, or a company that's thinking about hiring plans, CapEx. With all this uncertainty, I would think the logical action is not to do anything. And that becomes an action. And the longer this lasts, does that have a drag on growth? And then the Fed will have to weigh. So that's why I'm sort of, it's a long answer to your question on high inflation. But the Fed will have to weigh that inflation along with that uncertainty growth shock. And what they did in 2019 was look through the price shock. So ultimately, I think they're going to look at the growth side. And if that's weak, I don't think it'll derail any rate cuts. It might just delay it. And so the market might price it more at the end of this year, next year.
I think that's incredibly astute, because we also have heard from a Powell whose language has been, I know we're in a blackout period now, but on Friday he said the costs of being cautious are very low. But it's different than at the end of last year, when they were willing to talk about the inflationary aspect of tariffs to come, and they were willing to kind of forecast ahead of that. Why aren't they willing to give some sort of read-through to what tightening financial conditions might be? Why aren't they willing to kind of forecast more help needed for growth, more cuts to come? Why are they backing off of that?
So, you know, I think they also don't know. I think the key assumption maybe they made, certainly the market made, was a lot of the tariff talk, or, you know, lots of growth negative talk was a negotiating tool. And we would get deals. We wouldn't actually get all of them because deals would be struck. We haven't really seen a lot of that. Now, it's still early days, and maybe deals will be struck and these tariffs don't last. I think that's one assumption that's becoming a little shaky. The other assumption was that there's all this good stuff that's going to offset the bad stuff. We're going to get tax cuts. We're going to get deregulation. Well, we're not really seeing them. And so the growth negative aspect is sort of overshadowing what potentially good stuff could happen. Now, the Fed doesn't know, and they're looking at an economy that's, I would argue, growth side is still okay. I'm getting nervous about that tail risk of a recession picking up. I think the market's starting to price it in. We're nowhere high priced for recession right now in any market. But the Fed is looking at financial conditions. They've tightened, but actually they've only tightened marginally. Now, if you get another 10% drawdown. I don't know what that, magic Powell put is. But at some point, those financial conditions will be tight enough. We're not there yet. Then I think you'll hear the Fed starting to say, well, maybe that's another downside risk to growth. we're not there yet, which is why I think the market's very sensitive to negative headlines in terms of either growth. I think inflation less so. Maybe a hot print is slightly negative for risk assets, but we're going to be watching what's happening on the tariff trade war, because now the retaliation is starting, and April 2nd is not that far away. That's like that key date.
It's really not. I mean, I wrote down some of the time codes yesterday of Bloomberg headlines. Crossing at 10 a.m., we got that Trump headline saying he's increasing Canadian steel. By 3 p.m., he said he may back off of it. And then by 4 p.m., they say the 25% tariffs are going on for everybody. I mean, that is some serious fire hose inundation with headlines. What does it mean for a market to condition itself where it feels like every day you might get a new headline and you might get a new tariff?
I think what that's telling you is the risk premiums should be higher. And that's why you've even seen credit spreads, I mean, widen out. You look at how strong company fundamentals are. Companies are not re-levering, but that explains why spreads have widened. But I would say in all this uncertainty, the one thing we've seen consistently now this year, and it sort of goes back to where we were pre that inflation spike, is the negative correlation between bonds and stocks. It's here. It's every day. Yesterday, you get the positive growth headline, positive headlines for risk assets around the Ukraine deal, these additional tariffs coming off, and you see that immediate reaction in rates. So I would say this is why fixed income, actively managed fixed income, where you can, figure out which sectors might be more impacted by tariffs or DOGE, sort of down, underweight those. So if you can actively manage fixed income, high quality fixed income, this is why we're seeing the flows. And you can see that duration is finally, so owning 5-year rates or 10-year rates is actually finally being a diversifier. So you're getting that income, you're getting 5.5%, let's say, in a high quality fixed income, with that diversification benefit. If you're heading into a recession, you're going to get a lot of price performance for fixed income. So amidst all this, volatility, I think people are saying maybe we should reduce some of our risk assets and go into fixed income, which will give you that ballast to your portfolio, allow you to hold on to risk assets and give you that protection in case, we do get a recession.
Well, but we've gotten really used to post-COVID, this 5 years of really exceptional growth that has powered risk assets. Are you describing a rewiring that needs to happen, that we can't get used to the scenario where stocks always beat bonds so you can ignore fixed income and put all your money into risk?
I think a lot of that is risk-adjusted returns, and those risks were lower, I would say, the last few years. The US was the engine of growth. Well, we're questioning that now. Maybe it's going to be from Europe, maybe it's going to be China. So that risk of that US exceptionalism from a growth fundamental standpoint is a little lower now. And then you've got these risk outcomes. The distribution of outcomes has just widened a lot. We're talking about recession really for the first time since SVB, I would argue. And we're looking at policy levels. We just don't have the ability to get fiscal easing. In fact, I would argue we're probably going to see fiscal consolidation with DOGE, with the House passed spending cuts. So that's actually a downside risk on the fiscal front. And monetary, that's where inflation becomes important. How much can they cut? If inflation is above their target, the Fed is a little constrained. So I think in this wider so to your point, whether stocks will always outperform, well, we'll see. On a risk-adjusted basis, I really struggle to see where that outperformance is going to come in, at least right now.
So we're just waiting for a Trump put or a Powell put, it sounds like, someone to save this market. Priya, really great to see you. As always, thank you so much for coming in nice and early for us. Priya Misra of JPMorgan Investment Management. Let's now get you some other stories that are trending on the Bloomberg terminal this morning. Rheinmetall is predicting revenue growth by 25 to 30% this year as the German arms manufacturer benefits from surging European defense spending. The CEO says the demand is bringing growth prospects in the coming year that it's never experienced before. Shares have surged more than 1,000% since Russia invaded Ukraine and more than doubled in the past year. Porsche lowered another profitability goal it set at the time of its blockbuster IPO. The manufacturer is now aiming for a return on sales between 15 and 17%. That follows some lackluster earnings with weaker sales in China. Porsche will start an extensive rescaling this year, investing in models, software, and batteries that it said will hit the year's results. Meanwhile, in Washington, D.C., House Republicans passed legislation to keep the government open past a Saturday shutdown deadline. The bill will likely need the support of at least 8 Democrats in the Senate to become law. Speaker Mike Johnson spoke to reporters after the vote.
I believe the Republicans will stick together in the Senate as we have in the House, and I hope they're at least a number of Democrats in the Senate who will do the right thing. If not, this will be on their shoulders, and everybody in America knows that.
And coming up, we're going to be speaking to Flack Global Metals founder and CEO Jeremy Flack. That is coming up next on your brief. This is Bloomberg Brief, and you're looking live at the Principal Room. Coming up later today, an interview with Charles Schwab President and CEO Rick Rooster. That's at 7:30 a.m. Eastern, 11:30 a.m. in London on Bloomberg. Some breaking lines to bring you from Russia's Interfax reporting that Peskov is speaking, saying that Putin-Trump may hold talks after Jeddah. Again, Putin and Trump may be holding a call after talks in Jeddah. Peskov also speaking on the Ukrainian truce that was agreed, that 30-day truce, saying that they are waiting for details, saying that we have planning to have contacts with Americans in the coming days, and the Kremlin expects the U.S. to inform Russia about the results of the negotiations with Ukraine and Jeddah, again planning a call between Presidents Trump and Putin after those Jeddah conversations. Okay, elsewhere, back to our main story this morning. President Trump's metals tariffs have officially kicked in. The U.S. administration has imposed 25% tariffs on steel and aluminum imports, quote, with no exceptions or exemptions for Canada or any of America's trading partners as of midnight last night. And we have the perfect guest to take us through what it all means. Founder and CEO of Arizona-based steel distributor Flack Global Metals. Pleased to say that Jeremy Flack joins us in studio now. Jeremy, thank you so much for joining. Great to see you this morning, bright and early.
Thank you.
I know you're on Arizona time, so we're especially grateful.
Take it easy on me.
I will do my best. Well, look, it's not me that you have to worry about. It is headline volatility after tariff going forward, going backwards. Just how much clarity do we have at this moment?
Well, we think we have a little more clarity than we did last time around for the first Trump administration. The first Trump administration, there was a 232 tariff imposed, and quickly, within months, it became gutted. So they gave exemptions, and within 12 months after the tariff was announced, pricing was back to where it was before we started.
So is your expectation that that won't happen this time?
Well, the administration's been pretty clear this time that there will be no exemptions. In fact, yesterday Australia was here in the United States lobbying for an exemption, and they were denied the exemption, and the administration came out and said we will not have exemptions, and that's putting a floor under pricing in the United States.
What has pricing looked like? To what degree have we front-run this? Because this was a well-telegraphed date, despite some back and forth on headlines about what percent they would actually be. To what degree were markets already anticipating this day?
Pricing started moving about 7 weeks ago in anticipation. Then when he announced it, prices moved up a little bit less than the 25%. But the important thing here is that while prices have moved up, what have they moved up from? I mean, we're dealing with a commodity. And they moved up from very low prices. So steel was about $675 a ton in January, and it's up to about $900 a ton today. But importantly, the $900 a ton as a reference figure is lower than the 5-year historical average for steel. And I can remember in 2008, steel prices were $1,100 a ton. So the idea that we're going to have exceptional demand destruction from the tariffs on steel and aluminum is a little bit misguided and not true.
That's a really interesting point, that we're far below the average. So where do you expect prices to go? Do you expect us to be able to maintain something that looks like an average price even with these tariffs coming on? Well,
it's hard to make predictions. We're in a very high volatility situation now. We trade the derivatives for steel on the Chicago Mercantile Exchange, and the forward market actually appears to be completely disjointed. The forward market is now trading headlines, which for our market is quite unusual. So what we can say is a lot of liquidity has come into the forward markets. Liquidity's dried up a little bit in the physical market because folks were prepared for this, and there's a lot of inventory right now. So the net impact of this, it's just a lot of hype and maybe not a lot of reality.
If we cast forward, and maybe a reality check on this too, because one of the concerns is that now you have Canada who reroutes its trade, that rather than trading with its North American partners, a lot of the metals find its way into the EU. And then the EU has to grapple with this idea of more metals, maybe cheaper metals, and a disruption to them. To what degree do you expect a rerouting of global trade, specifically coming from places like Canada?
It's a whack-a-mole situation, Danny. So imports will find their way here at some price because we're actually steel short in the United States. The point of the tariffs on steel, certainly, and aluminum is to is to bring production here and to assure a market here for the steel manufacturers and distributors here in the United States. And by and large, every administration, back to you, Clinton, Bush, Obama, Trump 1, Biden, Trump 2, and we've been protecting the steel industry in this country to our benefit as manufacturers. Our company manufactures construction products out of steel. And if we don't have prompt steel rolled to our specifications here in the United States, we'll cease to function. And the last thing we want as a country really is to deindustrialize like what's happening in Europe. So the trades will flow around the world, but we must produce our own steel here, especially if you look at the Trump administration's push to build ships. So are we supposed to bring steel from somewhere else to build a ship here? It doesn't make a lot of sense.
How long is this process, though? If that's the destination of the journey we're going on right now, how long is that journey to get that goal that Trump wants?
It's a long journey, and I can't speak to the shipbuilding business, but what we're
I wouldn't ask you to, but in general.
what we're really saying is that there's a long history of protecting the steel industry in this country to our benefit. We have the lowest carbon footprint, highest efficiency, highest quality steel mills in the world in the United States. You can't put an AI or an NVIDIA chip or some kind of a computer program on a coil of steel. And if we don't have it, then we can't make the things that have those technologies in them. It's just a coil of steel. We must make it here. And so the point of this is to continue to protect this market. There are countries that build steel mills expressly to ship steel to the United States. And that's fine, but we have to have competition, but the pricing had gotten to be so bad here that it is, if the steel mills don't make money in the United States, then they can't reinvest. And they have been reinvesting at a dramatic rate. There seems to be a misconception that we're not, quote unquote, adding capacity and that it's been a net zero. It's not really true. We've shuttered old, high carbon emitting factories, steel factories in the United States over the last 30 years, and we've replaced them with the most modern factories in the world. And so the idea that it hasn't worked or that the trade protection hasn't been a good thing, think again, it has been a good thing because we're self-sustaining.
I think, again, some of the concern in the wider business community is just the volatility of these tariffs and the uncertainty of it and whether there will be exemptions to come. Does that volatility in itself have an impact on the ability for industry to ramp up, on the ability to really commit to various plans if you don't know day to day exactly what the tariffs will look like?
Certainly, it has an impact, and what we're seeing now is a lot of caution. Our customers are very cautious, a bit stocked up in advance in anticipation of this. We have some examples in the past where the administration gutted the tariffs, and then the prices fell right afterwards. And so people are nervous, and there's a feeling in the marketplace that this just might be a temporary bubble.
Jeremy, just quickly, if prices do start to rise, who undertakes that burden? Who eats that cost?
Well,
is it the end consumer?
That's a very interesting question because I've been doing this for a long time. I've seen steel prices at $200 a ton and at $2,000 a ton. And somehow we continue to make products out of steel in this country. And if you look at the steel intensity in an automobile, it's probably $1,000, $2,000 worth of steel in a car. So we're in a very volatile steel market in the United States. This is the most volatile steel market in the world. And so the supply chains are kind of used to this, Dan.
Right. Okay, Jeremy, so wonderful to have you, and you have to come join us again with an update on what you're seeing in the markets. That is Jeremy Flack, founder and CEO of Flack Global Metals, and you are watching Bloomberg. Let's get you set up for your trading day on this Wednesday. First, the big one. 2.5 hours time. US CPI will be coming out. We're expecting a 0.3% increase on headline and core month over month. Then we'll get the Bank of Canada's rate decision. That comes at 9:45 a.m. We're also going to get more earnings on deck. Adobe will be reporting after the market close. Futures heading higher this morning on the brink of a correction. That is it for your Bloomberg Brief. Surveillance will take things from here.